Buongiorno, following my latest video about the VIX volatility index and the reversal pattern of the stock market that I kind of predicted, the news continue to tell about recession, Trump trade war, America is dangerously close to the worst kind of recession. The saga continues, but let's dig down why they say that. So the quarterly annualized partial GDP growth was released as minus 0.3% negative. So what is a recession? A recession is when we have two GDP growth in negative, and that's why the stock market freak out, because it went negative for the second time. But last Friday, basically 2 days ago, the stock market in fact opened deep in red and then closed at the end of the day trading in high positive green. Let's analyze why. So how you calculate the GDP? The GDP is calculated by import, export, consumer spendings, and so on and so forth, many other variables. This minus 0.3%, how happened? So basically during this past quarter, all companies imported a lot of goods and materials because they are forecasting and they want to prevent to buy those materials at a higher tariff that Trump expects to impose. So we had in the past quarter basically a surge of 41.3% of imports. So this is something that it's not common, it's a one-time percentage that's happening. But if we deduct, so the imports, of course, they contribute 5% on this quarter GDP growth estimate. So if you take out this 5%, actually the GDP would be 3%. And that's why at the end of the day of Friday, the stock market rally up because they released the other news that yes, was minus 0.3, but in reality 5% was deducted from just the import. So why so? When a country imports stuff, actually when a country exports stuff, the GDP is positive because export and takes money. When a country imports, there is a big spending, and so the GDP goes down drastically. And the import was never a 41.3% rate in the past, but just because of this panic of these tariffs, all companies imported stuff, and so the GDP went down substantially because of that. But if you extrapolate the import spike, that exam was attributed to business front-loading goods to avoid anticipated tariff imposed by Trump administration. If you take out this outlier, actually the GDP was positive. And in fact, and by the way, we had consumer spending at 1.8% and businesses investment at 21.9% surge. So actually our economy was super strong. In fact, you can see here from the core PCE index, which is the inflation rate, was expected to grow to be at 2.6%, and in fact, the actual one was 2.6%. And the real consumer spending was estimated to grow 0.5%. In fact, it was 0.7%, even more. So the economy, after this, basically, they announced all of these PCE price index, core PCE index, the real consumer spending, they were all positive. Basically, inflation keep going down and consumer spending going up. The stock market by the end of Friday surged again. But you remember this slide I showed you in my latest video, short the S&P 500 by Bank of America? Well, good that you didn't do it, because actually I can proudly say that I was right. Okay, so let's see the technical chart. Let's actually see this side of the chart, which is the most important. You remember, top minus 20% touch, where you can say there is a sort of a recession. It touched the recession, it didn't touch it and went up. I did an entire video of this explaining why I thought we are going up and not down from here. You remember I showed you the video of the VIX when it goes above 60 and touches below 35 usually is the bottom. Then we talk about the Williams percentage R, but I'm gonna guide you through this again one more time. So there is this trend line that everybody is looking at, and there are those level of support and resistances, and obviously the EMA. So what we see here, this is a trend line that every trader follows, where we have lower high, lower low, lower high, lower low, lower high, lower low, lower high, and everybody thought we're gonna have a lower low because this trend line act as a resistance. In fact, when the stock market touch here, go down, touch here, go down, touch here, go down, touch here, everybody thought it might go down again, but it didn't. He actually reacted with a bullish pin bar and 4 other bullish pin bar that are in the following 4 days. So usually when you have four following continuing days, an uptrend is almost confirmed. This could have been also a fake out to get, it's called a bullish fake out, to get basically all the stops of people and then go down again, but it didn't happen. Also what we see here, the 20 EMA, the pin bar, the candlestick goes above the 20 EMA, so short-term trend confirmed up. Then we have the Fibonacci level, these are Fibonacci level, and then we have this level of support slash resistance here, that it was respected again. Support, it became resistance, and it broke up out again. Let me show you something in the next slide, so you see what I was telling you. By the beginning of Friday, we open below this trend line, and everybody freak out. They say, okay, this is another bounce back. But then by the end of Friday, because of those core CPE and all those positive notes, we closed again back up. And we closed up on the 20 MA, and we had 4 other consecutive days of positive reaction. Another things to take into consideration is, for example, you see this level of support, resistance, we broke. So we broke the level of support resistance, we broke the trend line, we went above the 20 EMA, and what else? And let me see if I have in the other slide. Yes, here. In the other slide, what we have also? This is the weekly chart. So in a higher time frame, you can see that this is a force bottom, meaning we have this level of support that was respected here, and then was broken down, and went back up. How you call this? False bottom. Why this happens? So basically every trader, day trader, weekly trader, they put their stop loss here. So if there is a level of resistance here, they put stop loss little below, so here. So what they do, the market makers, the manipulators, they force people down, so they take out all this stop loss, pushing the prices down, the price action down. They take all the stop loss, and then these bank market makers, they go straight up. And this was another bullish candle, followed by other 4 bullish candles. So basically, usually when you take this stop loss, then you go on a great wave up. Another things I want to show you, let's see if I have in the other slide prepared. Yeah, the Fibonacci level. Here we are again on the daily chart. So if you take point A, which is the top, going to point B, which is the bottom, and do the Fibonacci retracement level, we have the 0.3% Fibonacci, 0.5 Fibonacci, and 0.6 Fibonacci. We broke on those one. The 0.6 Fibonacci retracement is a very strong level of resistance. So what could happen? That we're gonna go up, have some sort of back and forth here, and then if we can break above this level with a nice green candle, then we are on the way up. But I can predict that we could touch here, and either it's gonna go again back down, or if we can have some sort of uncertainty and then close back above, then we are on the way up. This is all thinking that nothing crazy would happen, like Trump or Putin or the Chinese president, they will not say some crazy stuff, and then of course will be another panic. But based on price action, this is what could happen. I would give a 70% probability that we're gonna go up from here, and of course a 30% probability in case something crazy happens. I want to show you another slide that I didn't show you before, which is this one. You remember we talk about the VIX, but we talk also about the Williams percentage R. So the Williams percentage R52 and the Williams percentage R13, they are an amazing stock market indicator. Every time the Williams percentage 52 closes below the 75 level, or in the Williams percentage 13 as well, every time it closes below, it's signal the bottom, up. See, below, bottom, up. And now where we are? Here, bottom. What do you think will happen? Up. I mean, this is price action, guys. This is not, I didn't invent anything. All right, so then, again, if you would have listened to the news, of course, you would have not made the right decision. But let's talk about what really happened in the news, actually. So look, in 2023, why a global recession is inevitable, 18 November 2022. Deutschmark, the stock market will fall 25% when the looming US recession hits middle. Deutsche Bank said this in 2022, and then December 2022 again. Recession, S&P 500 facing an historic warming after a year's long, 22. And then what happened? What happened? Where I am? 2023. After 2022, what happened? 25% gain. 25% gain. So if you would have listened to all this news, you would have missed on a 25% double-digit gain. And again, 2024, 25% double-digit gain. So, what is the stock market, in my opinion? The stock market is not the economy. The stock market is a leading indicator of a 6 to 12 months lagging on how the economy will be. The stock market now doesn't reflect the economy now. The stock market reacts based on what it thinks that the economy will be. And by the way, every time they announce a recession, by the time they announce it, it's already almost over. Look, up in here, they announce recession here. And then look, they announced recession here, sorry. After all this basically recession happened, and then they announced that we are not out of recession, we are, the stock market is bouncing back from the right reason, here. So if you would have bought here, guys, look, the recession has already happened. This was 2022. The recession, 2022 and 23. The recession has already happened, so by the time you say, okay, let's buy again, we are safe, you are buying stock overpriced, and you're gonna lose money again. I mean, I don't know how to repeat this anymore. I'm nobody to tell you what to do. I'm not a financial advisor. I'm just thinking out loud and thinking on price action. Anyway, I hope this was helpful. Follow my video. Thank you.